Wow, this new camera, that's fire. All right, so I recently laid out a three-part test in my Substack to determine when the new bull market was really ready to rip higher. All right. And if you're not part of my Substack email list, there's a link below in the description. Join it so you can keep up with me. All right. So the three-part test was as follows. ARKK, which is the ARK Innovation ETF, needs to trade at $50 or higher for a sustainable period of time. The thinking behind this particular factor is that ARKK has so many of Fourth Industrial Revolution, growth stocks, future stocks, innovation stocks, America 2.0 stocks, that if it is consistently seeing buyers come in and willing to support it at 50, it would mean that the Teslas of the world, the Squares of the world, and the Coinbases of the world, well, those stocks are also seeing interest and people are coming to buy them. And it would be a signal that the buyers are back. With the buyers being back, the liquidity is back, and also mean that, hey, even the long-term buyers are going to come back. And now we have the setup for where there's layers and layers of buyers, layers and layers of liquidity that can set really in motion rising prices, which is what a bull market is. So on that note, ARKK, not yet. $50, it's close, but we really haven't seen it trade at 50, let alone trade sustainably at 50. So that one, not yet. The second one that I laid out is the bond market and focusing on long-term bonds. You can track this by tracking two ETFs with the ticker symbol TLT and IEF. Right now we have no team, so we can't put those ticker symbols on the video, but hopefully soon, or else I will train myself to do it. But TLT, IEF, TLT represents the 30-year bond, IEF represents the 10-year bond. And the thinking behind this is that, well, the reason why our stocks got really crushed is that the Federal Reserve, starting about January, February of this year, said, hey, inflation, major problem. We are going to absolutely crush it, crush it, crush it, even if we end up blowing up a whole bunch of stuff in the process. Well, one of the things they definitely blew up is our stocks. I mean, because our stocks crashed after that, really after the Federal Reserve made this a big priority. So the reason why TLT and IEF are relevant to this is that if inflation is a problem, nobody in their right mind is buying bonds, especially long-term bonds, where you're going to get your money back 10 years from now. Because remember, the essence of inflation is that future money is worth less. So why would you buy a 10-year bond? In other words, you're handing money over to somebody else to get it back 10 years from now. And if inflation is going to be high and rising, you'd be crazy. I mean, in other words, you're getting way less money back. And, forget 30 years. I mean, who wants to do that? So if bond prices are rising, it means that actually the interest rates on those bonds are actually going down. There's an inverse relationship between interest rates and bond prices. So here, there's actually very good news. TLT and IEF have been trading in this kind of tight range, and they've broken out past sort of their highs in May. And that's a really good sign. The 10-year bond is now well below 3%. It peaked out at about 3.6%, so it's nearly 1% lower. And that's a strong signal because the 10-year bond is followed by all market professionals. I mean, this is like the standard. Many people even incorporate it into their financial models as a way of discounting. In other words, trying to sort of time effect money. The 10-year bond is used as the benchmark. So this is a big deal. And I would say I'm willing to give this a check. In other words, the bond market is reflecting the fact that inflation is not going to be a long-term problem. In other words, somewhere in the next 12, 24 months, inflation is going to recede. With that, bond yields will continue to go down, bond prices will go up, and that would be good for our stocks because one of the reasons that people sell off growth stocks during periods of rising inflation, rising rates, is that they say that, well, the profitability for these growth companies is way out there in the future. And if inflation's rising, then the cash flows that are going to be represented in the future are worth less because of inflation. And other people also say that if inflation is rising, rates are going to be going higher, and it creates an alternative other than growth stocks, or for that matter, any stocks, for you to put your money into. So stocks as a whole are losing market share. So that's the basis for that. All right, so I'm going to give the bond part a tick. All right. The third one is rhetoric from the Federal Reserve. And on this, I would say we're definitely not there. The Federal Reserve is still talking a good game on inflation, even though their interest rates lifts are causing really a massive slowdown in pretty much every important market, whether it be the housing market or the market for any number of goods and services. You're starting to see these all roll over. That's telling you that at the very least, a slowdown is coming. At the worst, a recession is coming. And certainly globally, there's a huge slowdown of economic activity that is unfolding, which of course eventually hits a lot of American companies that export. But yet the Federal Reserve is saying that they're going to keep going forward and keep lifting interest rates. And on top of that, they're also doing something which is called quantitative tightening. And to keep this short, quantitative tightening is essentially the Federal Reserve buying a ton of bonds from the bond market to keep interest rates fairly low. And they've been doing this for about 14 years. They started this in 2008, and they've continued to do this because they've felt that the economy, our country, we needed low rates really to stimulate economic activity. Now they're saying, hey, we don't need to do this anymore. And it's causing absolute chaos in the bond market. If you're following me on Twitter, you'll see I tweeted yesterday about this. The Treasury market is in chaos, and it's just a matter of time before this rolls itself out into the bond market, the mortgage market, pretty much every market on earth. And here is really where I think that we're going to get very close to this Fed rhetoric part, because if bond markets are locking up, the Treasury market is the most liquid market on earth. You want instant liquidity, meaning you really want cash. You can sell hundreds of billions of dollars in a day. I mean, you could sell hundreds of billions of dollars probably in a few minutes, but not right now. I mean, that market is very tight. People aren't buying and selling like they used to because of what the Fed is saying, doing. And that tightness is going to spread into other markets. And that has the sniff of 2008. Just to be clear, there is no economic crisis. But one of the things that happened in 2008, and I was managing money back then, so I remember this very well, is that the credit markets, bond markets, all locked up, and regular companies like General Electric, 3M, and others, just companies that made stuff that had nothing to do with the financial system, just couldn't get financing. And I can tell you that this is something that keeps the folks at the Fed up at night. Like, they want nothing to do with markets locking up. Anything that has the taint of 2008 is terrible for them, because this is one of the things that the Federal Reserve is responsible for, is making sure that these markets are liquid and you don't cause a problem as a result of what you're doing for regular Main Street sort of manufacturers, traders, or any kind of company that just does regular stuff. But it does look like this is beginning right now, and you can be sure that the Federal Reserve knows this, because they're in charge of, making sure that all markets are liquid. They can definitely see, when there's tightness going on, and that would tell me that they're going to be watching this pretty closely. And sooner rather than later, they're going to start to say, hey, well, I think we may have done enough for inflation, and there's markets locking up, and hey, we may need to do something here to make sure these markets don't lock up. Else there's going to be a situation where lots of companies can't sell bonds, can't get credit, and that would really affect the economy. And truthfully, for the Federal Reserve, it would also affect their reputation. I mean, in other words, if they can't really stop another sort of 2008 credit like locking up scenario from unfolding, politically they're in big trouble. They're in big trouble. In other words, they're trying to, make sure that there's no inflation. In the process, they're causing, an even bigger problem. So I have said, and I put myself on the record, that the Federal Reserve wants nothing to do with any scenario that feels, looks like, is anywhere near 2008. And they will absolutely blink, they will absolutely fold the moment this becomes anything near reality. And if you go look at my tweets and you go look at the reporting that's on Bloomberg, it would tell you that the Treasury market is beginning to show signs of locking up. That will for sure transmit itself into the corporate market, and then it will transmit itself to the mortgage market, which would be the housing market. Now, with that, you will see the Federal Reserve shift its rhetoric and then probably start to lay out a scenario for lowering rates, reintroducing quantitative easing. Who knows? I mean, how far they'll have to go in the other direction to reverse things. But that moment is fairly clear. So I would say on the Fed rhetoric part, on my three-part test, is also not yet, but getting very, very close. And I think that with the shift in rhetoric, that's when ARKK will, I think, surge past 50. Our stocks will start surging higher because what the Federal Reserve will be doing, when they shift rhetoric is also they'll be turning the liquidity tap on. In other words, pushing more cash into the economy. And with that, you'll see some of that move into the markets. And the place where you'll get the biggest move is the place that has been the most sort of like liquidity star, parched, if you will, and that's our stocks. And that's where you'll have the biggest impact because even a small amount of money there can push it higher. And I saw that in 2009. And I believe we're setting up for a similar scenario. So this is a macro update, a bull market update, sort of on where we are, three-part test. It's in my Substack. Make sure to subscribe to the Substack email link underneath, and also subscribe to our channel. Give me a thumbs up if you like this video, and come back again next week when I'll have another one. Until then, this is Paul saying bye.